Hello and welcome to part 2 of the lecture for chapter 18. In this section of the lecture, I'm going to talk about how the financial statements from a merchandising company and a manufacturing company differ from each other, and talk at length about the way costs flow through a manufacturing company and how we replicate that on some addendums to the financial statements, which I'll show you in a few minutes. This lecture will allow you to complete the homework for the second and third assignment in Chapter 18. So starting out with a comparison to the balance sheet from a merchandising company, which you're all very familiar with from Accounting 201 and 202, the main difference in the balance sheet is in the current assets section. So for a merchandising company, so companies that purchase product, put it on the shelf, don't change it, and sell it to another customer, like Target and Walmart and Costco and those kinds of companies. So their balance sheet is going to look like what you see on the top here. They have merchandise inventory as their only category of inventory. The lower balance sheet there for Legend Guitars, the example our textbook uses, shows what the same section of the balance sheet looks like for a manufacturing company. So the difference being that manufacturing companies buy raw materials and convert them into a finished product. So in this case, they have three types of inventory. So, and you can see they're listed all there with their detail and then subtotaled on the far right column. So those types of inventory are finished goods. Those are products that a customer could come in and pick up. They're complete and done in all respects, packaged, label, on the shelf, ready to go. The next category is work in process. That's usually a fairly small number for most companies. So it's the stuff that is on workbenches being worked on at the time that the month ends. So on the 31st of the month, quitting time at 5 o'clock, they shut the lights off in the company. What exists that is not finished yet but has been started? That's work in process. Some companies call it work in progress. Some people refer to it as WIP. W-I-P is the acronym for work in process. The third category is raw materials. Those are things that we purchased that are sitting on the shelf ready to be used in production. So in the example I talked about yesterday, or in the last lecture rather, about making picnic tables, our raw materials would be maybe 12-foot long 2x6s and 12-foot long 2x4s, so dimensional raw lumber, nuts and bolts, brackets, things that we've purchased from suppliers that are sitting on a shelf ready to be entered into the manufacturing process. So three types of inventory. Raw materials is how it starts, then work in process, and then finally finished goods ready for a customer to take. I added this slide from the original PowerPoint that I uploaded in this chapter because I wanted to talk to you a bit graphically. If we were in class together face to face, I would be drawing this on the board. So I want to take some time to talk about this before we look at how numbers move through T accounts and what some of the supporting schedules to the financial statements look like. So in this case here, I want you to think of these three blue boxes as different buildings on the site of a manufacturing company. It doesn't have to be that way. It could all take place in one building, but I think it's easier to conceptualize if we think about it in three different buildings. So the first building is our materials building. Some people call it raw materials. That's a warehouse with racks in it where stuff comes in. We make purchases. They come in from our suppliers. We offload the material and we store it in that building. So the building just has material that comes in from suppliers, and then that same material will go out into our factory as we require that material for production. So the production manager will issue a requisition saying, I need this material for this particular production process or job that we're working on, and that releases the material from that building, and that material goes over into the work in process building, which we can think of as our factory. So material comes from the raw material building into our factory. That's the middle direct material with the rightward arrow there. What else goes into the factory is direct material. So workers that are We're incurring costs for workers to put their hand on the product and do the conversion process, cut the boards, drill the holes, assemble things, all of that kind of work that factory workers are doing to transform the product. So that cost is flowing into the factory. I want you to think of these as cost flows, okay? So direct material, the cost of that comes into the factory. Direct labor comes into the cost in the factory. And then lastly, factory overhead is incurred. So we pay the light bill for the factory. We have supervisors that we pay in the factory to make sure everything is done properly. We have quality control inspectors. We have forklift drivers to support the activities of the direct laborers. We have depreciation on machinery and property taxes on the factory and the equipment. So all of those kinds of costs that are necessary because we're a manufacturing company. If we didn't make our product, we wouldn't have those costs. So all of those indirect factory overhead costs are also incurred. So I have three types of costs coming into my factory, recording what I'm doing all month long as I work on things. As I finish product, that gets then transferred over to our third building, the finished goods warehouse. So that's a warehouse much like the materials warehouse where product just comes in and goes out. No transformation is being done there, but the product is coming into the finished goods warehouse from my factory. It leaves the finished goods warehouse on the back of a customer's truck when they make a purchase. So the cost of goods manufactured statement is what is going to determine the costs that we move from our work in process factory over into our finished goods category as we move the product from the factory into the finished goods warehouse. That cost then is the cost that we record when we put it on a customer's truck and it leaves that building. So again, we're going to talk about costs, but I think it's good to have a framework in your mind of how things physically move in a factory and how the costs follow those movements. So here's the same information in T accounts. So that top T account for materials is like the first building in that factory. So materials get purchased, we debit that category for those purchases. Direct materials flow out of that into work in process, our factory. So as the cost of the direct materials leaves materials, we credit that to reduce it, and we debit work in process, the factory category. Now also shown here are some indirect materials like maybe glue and sandpaper and things like that that we can't measure directly. As I pull those out of my materials warehouse, I put them in factory overhead, where later we'll transfer them to the factory. I have payroll that I run for the company, where I'm paying all the workers for the work they do. The direct labor, people putting their hands on the product, that flows out of payroll, the payroll expense account, so I credit that, and I debit work in process. So if I have workers in my factory that are cutting boards and drilling holes, their wage expense does not hit the income statement until we sell the product that they're working on, because it's a product cost. It attaches itself to the product. So as I record payroll, I credit that account and I debit work in process to move the costs there. Lastly, I've accumulated cost in my factory overhead account, the one on the lower left there, indirect materials, indirect labor, other kinds of factory expenses like heating and lights and depreciation and all of that get recorded in factory overhead. And then I come up with a scheme, and we'll spend quite a bit of time talking about this, but I come up with a scheme for intelligently associating that factory overhead with what took place in the factory. So allocating it to the actual product in a systematic way. So I transfer it out of factory overhead into work in process. So now my work in process account has those three costs coming into it, being debited into that account: direct material, direct labor, and factory overhead. As products get finished, I credit work in process, so I reduce my work in process, and I debit finished goods because the materials have left one building and gone into the other building, in effect, if you think back to the last slide. So if I worked all month long and didn't finish any product at all, then I would have a lot of debits in my work in process and no credit. It's when I finish a product that I credit work in process and debit finished goods. It could sit in finished goods as long as it needs to until somebody buys it. So once somebody buys the product, then I credit the cost in the finished goods category because the material is leaving that asset. My asset is decreasing. So I credit finished goods and I debit cost of goods sold. That's where the cost hits my income statement. So here's a schedule that we'll be working on that supports what you'll see next for cost of goods sold. So this is a statement of cost of goods manufactured, which manufacturing companies need to complete generally every month. They may do it annually, but usually every month. And we'll see a similar pattern. It looks a bit confusing when you first look at it, but we'll see a pattern kind of emerge from this. So I start with what is my work in process inventory at the beginning of the month. So when I come in the first day of January, turn on the lights, what is the cost of the stuff that's on the workbenches that is in the process of being worked on in my factory? That's my starting cost. Then I want to add the cost of the direct materials that flow into my factory. So in some problems, they'll just give you that figure. In some of the earlier problems that are a bit more simple, they just say the direct materials used were this. In this case, they don't tell us that. So we need to do a little subroutine for direct materials where we say, what did we start with in our direct materials inventory? Okay, 65,000. We purchased 100,000, so 100,000 came in. So the materials available to be used were 165. So I've got 165,000 that could be used. If I don't use any materials at all, that will be my ending inventory in my materials building, okay? But I go out and I count my materials inventory at the end of the year here, and I see that I've got 35,000 sitting on the shelves. That I can back into the fact that that must mean then that 130,000 were transferred out of that building, okay? If I start with 65, I add 100, I've got 165. If I have 35 left, 130 must have left the building. Okay, so I've got 130,000 of materials that were used. I've got 110,000 of direct labor that came from payroll, and then I've got some factory overhead, indirect labor like supervisors and forklift drivers. I've got depreciation on factory equipment, and then supplies and utility costs, 10,000. So I've got 44,000 in overhead. So those are my three types of cost: 130, 110, and 44. Okay, direct material, direct labor, and factory overhead. So now I can add that to my beginning work in process. So I started the month with $30,000 worth of stuff on workbenches being worked on. I added my three types of costs for all the activity during this year. And that leaves me with a total of $284,000 worth of cost incurred during the period. I add that to my beginning. I have $314,000 worth of costs that were incurred in my starting and incurred in my factory. Now I take and count what is on the workbenches at the end of December. What is my ending work in process inventory? That's $24,000. So if I had $314,000 worth of cost and I have $24,000 that's still sitting there at the end of the month, it must mean that $290,000 flowed out of my factory into my finished goods building. So you'll get more comfortable with these as you do a few of them. So the last financial statement is the income statement I want to look at. So in a merchandising business, we just have cost of goods, cost of merchandise sold. That's pretty straightforward. The diagram that's shown there is a periodic inventory, so I won't go into that too much. The one on the left. The one on the right there bears more examination. So here I've got my cost of goods sold section on my income statement. So this pattern is the same. What was my beginning finished goods inventory? So how much did I have in that finished goods warehouse at the beginning of the month? What was my cost of goods manufactured, which we determined from the last statement we looked at? So how much flowed from my factory into my finished goods building? That tells me the cost of all of the goods I have available to be sold, okay, that customers could take. And then I count my inventory at the end of the year. I subtract that. That tells me how much must have left. So that's my cost of goods sold. I subtract that from my sales to get my gross profit, which of course is a very important number for any manufacturing company, any merchandising company as well, but in particular any manufacturing company. So that is the end of the lecture for Chapter 18. Please work on the homework that I've laid out, and as always, don't hesitate to email me if you have any questions at all. I'm happy to email back or schedule a time where we could chat. Thanks a lot. Bye-bye.